Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. I'm very excited for this episode. We are joined by an expert investor all the way from the United States. He's joining us from Philadelphia, and we're going to unpack how he approaches investing, his philosophy, how he finds multiple ways to win with investments, and then a look at his portfolio today.
Without further ado, it is our pleasure to welcome to the studio Sorin Roibu. Sorin, welcome.
Thank you. Good to be here.
So Sorin is a portfolio manager and research analyst at Brandywine Global, a Franklin Templeton company. And we want to say thank you to Franklin Templeton for supporting this episode today. Now, Sorin, as Ren said, we're going to cover off your investment philosophy and some of the stocks that are in your portfolio. But let's start at the top. What is your investment philosophy?
That's a good question, and I'm supposed to be doing this in an elevator pitch, but allow me to elaborate a little bit because it's really at the core of what we do here at Brandywine. So our investment philosophy centers on the value investing as an investment style, but with a global and opportunistic approach. We believe that paying less than intrinsic value for a business is a winning strategy long term. However, our approach is a little bit more nuanced and multifaceted. We care a lot about the macro. We're macro aware. So we'll utilize those macro insights to make sense of the world. We're also pragmatic stock selectors. And we'll unpack that a little bit later. But the way we think about valuing a business is a little different than your mainstream value investor style. We have a quality focus. We like companies that are just good businesses, not a lot of debt. ESG is very important. We think it's the future of this world, and companies are very much impacted by ESG factors. But more importantly, we have a long-term perspective because we believe that over time, the market eventually reflects the true value of the business. So a combination of all this is how we think about our investment philosophy.
We want to unpack, I guess, some of the elements of that philosophy. And let's start with value investing because it's probably one of the more, I guess, overused terms in investment circles. I certainly remember when I started investing, it was you want to be a value investor. You want to buy things for less than their intrinsic value. But I guess like the definition has been stretched and contorted in different ways over time. So what is true value investing for you? And perhaps what should we avoid when we see other managers perhaps misusing the terms?
The mistake that many investors make is they confuse the value of the business with the price that they see. My co-manager, Jim Clark, likes to say, if you went to a car dealership and told them, give me the cheapest car you find, they'll give you a real cheap car. You probably won't make it home. But that's really the difference. The way we think about true value investing is really understanding and buying something that is less than its intrinsic value, that's priced lower than intrinsic value, instead of just chasing low valuation ratios. So, but to do that, you have to analyze the business quality, the profitability of that underlying business. What's the growth potential? All of these ingredients are what support that valuation. So many managers will just throw around low PE, low price to book, do the statistically cheap screens, when in reality, what they're getting cheap prices. They're not necessarily getting undervalued businesses. So that's one thing that we spent a lot of time just focusing on that to make sure that what we're buying is truly undervalued versus just cheap for a reason.
Mm-hmm. So you said in the first answer there around your philosophy, Sorin, that the philosophy at Brandywine is consistently value, but with an adaptive approach. You include macro and a few other elements. So can you elaborate on that? Like how far do you stretch beyond the true value and what parts of it do you adapt?
It's a great question. Let me first state that when we say stretch or adaptive, we're still true to the value. As I just said, we're looking to really understand the value of the business and buy it below the intrinsic value. However, what I would say is that if you're still doing value investing like Benjamin Graham did it in 1930s, you're probably doing it wrong. and the nuance here is that 100 years have passed. The makeup of the economy is different. The makeup of the world is different. So you have to evolve with that. So the way we adapt our approach is to realize that today the economy is a lot less capital intensive than it used to be in the 1930s, right? Less industrial, less manufacturing. It's a lot more capital-light businesses, technology names that grow without a lot of capital. Profitability is different too. So when we look at the world, we're trying to adapt and use the valuation tool that's appropriate for the opportunity, that's appropriate for the business environment that we're in, while still doing that basic valuation. We're looking at free cash flows, looking at balance sheet quality. All the formulas, the math behind it is still the same, but realizing that the competitive dynamic, the market backdrop, the economic backdrop is very different. So if you're just going to go there with a little measuring tape, trying to measure price to book across the board, you're going to find that the output is not necessarily what you wanted, because a lot of companies with book value is irrelevant. So this is when we say adaptive, as in, hey, we're still going to do value investing, but we recognize that times change and we need to change with times and make sure that our skill and our approach is relevant and still leads to good outcomes.
Well, Sorin, we've spoken about, I guess, the theory of it, but we'd love to now illustrate it with some practical examples in terms of companies that you're looking at, or that are perhaps in the portfolio that you think fit a modern view of value investing. So can you illustrate some of the philosophies that we've spoken about with one or two examples?
Sure. Whenever you see a valuation multiple, whenever you look at a price to book or price to earnings, PE multiple, which gets thrown around every day, you hear on TV, people need to understand that behind those valuations has to be a fundamental support. Those valuations have to stand on something that supports and that makes sense, that justifies that valuation. And the relationship and the way you get there is that every business, that if it makes money, that's a return. It requires capital, and then that capital gets put to work. They generate revenue at a certain margin, profit. That's your return on capital. But on the opposite side of that is the cost of capital, right? So the capital could be equity or cash or debt. All that costs money or has an implicit cost. The secret is this. You want to look at businesses and compare what's their profitability versus the cost of capital. And whenever that spread or that difference is positive and large, that means they're making money, they're creating value. And whenever that difference is negative, meaning that they're not earning the cost of capital, they are destroying values. So companies that are creating value by generating higher returns than the cost of capital, you want them to reinvest in the business. You want them to put as much, because that's how they compound capital. It's as if when you buy an investment, and if it goes up every 10 years, every 10% every year, in about 7 years, you'll double your money. It's the same way for businesses. On the other hand, if a company is not earning its cost of capital, you don't want them to invest in the business. You want them to pay everything out as dividend or maybe liquidate. So this relationship is so important, and so many people just ignore. They just say, oh, it's low PE. So when we look at businesses, we always, that's the framework we look. But at the same time, there's cycles. Everything is cyclical. So one example of a company that we like right now is FMC Corporation. It's one of the leading global agricultural chemical companies in the world. They do basically pesticides and whatnot. It's big in agriculture sector, but it has its own cycle. So whenever the farmers buy too much and then the crop is too weak, there's an economic cycle, but then there's their own cycle. Well, right now, FMC is going through an inventory cycle where they just have, there's too much inventory in the market. So prices are dropping, causing their earnings to be temporarily depressed. If you look at their PE multiple today, I think it's close to 19 or 20 times. You don't want to buy it, but that's the wrong way to look at it. The PE is useless. Sometimes they lose money during a downturn, cyclical businesses. So the way to do it is to, one, check to make sure that this is a cyclical decline and not a structural, meaning they're not being put out of business. And the second thing is you want to have an idea of how long does it take for this cycle to play out. So how long will it take for them to go through the inventories, and then once they normalize, prices revert to normal, profitability reverts to normal. You're looking for some sort of a normalized earnings level, and then you can apply a multiple and say, this is the intrinsic value of this business. So this is one example where a PE is useless because they're not making a lot of money, but it's a cycle. It's an inventory correction. You just play that. On the other hand, when we say value can take many forms, we're in Japan right now. The Japanese yen, everybody knows, has been very weak, but recently started to appreciate. Our team still thinks, our macro team still thinks that the Japanese yen is significantly undervalued. So the opportunity there is to get exposure to that currency. But how do you do it? You want to own domestic businesses. You want to own businesses that make money, make things, and pay for them in yen, and then they sell them in yen. You don't want to own exporters like Toyota, where most of the stuff they sell is outside of the country, because as the yen appreciates, they will bring less money on in Japanese currency. So to investors, if the Japanese currency goes up 15%, they don't care. It's going to show up in returns in the stocks in that particular country, right? So when we talk about multiple ways to win, you can invest in a cyclical. Sometimes you can invest in a currency that appreciates. Because at the end of the day, when you buy a foreign stock, you get exposure to that currency, the fundamentals of the business, but also the country exposure and the currency. And if they go up or down, that will impact returns.
Does your macro team have a view on what's happening now between the disparity of Australian interest rates and what's going on globally? Like, we're sitting here, interest rates are on hold. Everyone else seems to now be on a cutting, not spree, but certainly cutting. Do you have a view on that?
Sure. So the beauty about the cycles, right, that they are very similar. They're text by textbook. So an economy goes through a recession, then it comes out of recession, grows, peaks, rolls over, and decelerates again. This happens everywhere, but the difference is, or the advantage, the beauty is that they are rarely synchronous. So what you're seeing today is this move away from monetary tightening, the synchronous monetary tightening that we've had because of COVID. I was going to say they're rarely synchronous. Sometimes they happen. The great financial crisis, COVID has caused all the central banks or all these policies to kind of move in sync. So what you're seeing today is just slowly kind of returning to normal. Some countries, like emerging market economies like Brazil, they've already been cutting rates for a year before the developed economies started cutting rates. In fact, recently they hiked it because inflation has ticked up again. Countries in Europe, European Central Bank has cut rates. I think countries like Australia, and I don't need to tell you, but they tend to be more conservative, but they're generally more disciplined and more conservative when it comes to inflation. Ultimately, we don't know what inflation is going to do. We all think that there's enough reasons to believe for inflation to continue to go down, but it's not going to be a straight line. So what happens, many of these central banks, like Australia or like the Swiss central bank or other, they look at this as, I'm just going to wait. I'm going to wait and see, or I'll cut a little bit and then I'll see what happens. So I think it's this beginning of a shift in monetary policy, but not everybody's on the same page because their underlying economy is not on the same page. I think our macro team thinks that you fast forward a few quarters down the road, it's very likely that most of the world will be in a synchronous easing, because there's no need to have rates that elevated if inflation does indeed continue to go lower and lower.
Just have to wait it out, I guess.
We'll see, yeah.
Now, Sorin, when we were researching your fund, Brandywine Global and Franklin Templeton earlier, we came across this concept of finding multiple ways to win, and we wanted to sort of drill down on that, because I think when a lot of people listening build an investment thesis, they find a company that they like, and they create an idea of why that company is going to be successful in the future. And, part of, I guess, your process at Brandywine is to not just find that one way that you'll profit on an investment, but actually have multiple avenues to make money. So can you explain to us, I guess, how you approach this and how you build out investment theses, I guess, with multiple ways to win?
So Brandywine is well known as a fixed income shop, investment manager. We have a very good reputation for our macro research. For over 30 years plus, they built a big business and have done very well for our clients in country and currency selection. So we have a team of macro economists in-house that all they do on a daily basis is they look at the macro, they look at the world, they analyze business cycles, fiscal monetary policies. And what they're trying to do, they're trying to predict what is the most likely macro scenario that we will see in 12 to 18 months down the road. And the reason they're able to do that, because it's interesting at the macro level, um, there's these economic variables like interest rates and currencies, and they're all interconnected. There's a feedback loop between interest rates, currencies, and the underlying economy. As interest rates and currencies overshoot in one direction or another, they eventually impact their economic behavior. They act as economic governors, right? So you take your rates up all the way, you're going to slow the economy. If you cut rates, you're going to stimulate the economy. This is the mechanism. Now think about it. By monitoring that, they can predict, and they've done generally well, what's the most likely scenario, macro backdrop, given where the variables are today? So we looked at this and said, wait, this is a great insight, because if I'm going to invest in a foreign stock, I'm going to have an opinion about the macro anyway. I mean, you have to. If you're going to buy a bank in Australia, I have to have an opinion on the credit cycle or the interest rate policy. So how about we utilize our in-house macro capabilities, people who are trained in that, and then I can spend most of the time doing what I do best, is valuing businesses. So the multiple ways to win, kind of the secret sauce to this, is the first step in putting together a portfolio. We lean on our macro team to narrow down that investable universe from 40 plus countries to a subset of 10 or 20 where we think there's some macro tailwind. Either the currency is cheap and appreciates, or they're about to see a pickup in business, in economic activity. Because realistically, it's much easier for a business to do well when the economy is doing better than not. And that same applies to stocks too. So that's part one of the multiple ways to win, is that most global equity managers look at the benchmark and then they go overweight or underweight. For us, the starting point is not the benchmark, is where in the world do we think we're going to be in a much better macro position in 12 to 18 months from now? And then let's go and see which businesses are best positioned to benefit from that. That's the second part of this process, where if we think rates are going to go up or go down, we ask ourselves, so what are some of the businesses that will do well in that environment? If we think that the currency is going to depreciate, again, simple question. I know it sounds simple, but what companies would do well if the currency depreciates? And you immediately prioritize your list to, wait, it's the Toyotas of the world, it's the exporters, it's the companies that sell in dollars. So this is how we use the macro lens with the market assessment as multiple ways to hopefully put ourselves in a position to win. And then from the bottom up standpoint, from the value investing, we look to get our margin of safety just from the valuation. So you combine the three, we think we have a recipe that should do much better over time than if you just go strictly bottom up or strictly top down.
Well, Sorin, let's use that investment philosophy and framework to dig into your portfolio as it stands today, because there's some pretty interesting things, and we're keen to hear your take on some of the positions that are in there. And we want to start with one of the big things that stood out to us, and that was how underweight you guys are when it comes to tech. Index is 26%, but your portfolio only has 4% of the Mag 7 in your top 10 holdings. So can you talk to us about your view on large cap US stocks? Because I'm sure most of the Equity Mates community listening today have a reasonable chunk of their top 10 in the Mag 7. So yeah, can you talk us through it?
I'm glad you asked that. Look, it's been beating the market has been hard, and in big part because of the concentration in some of these mega tech companies. So let me address the question first, the big underweight. If you look at what's underneath that, there's a couple reasons for that. The first reason is that from the macro standpoint, we believe that the U.S. economy is going to see headwinds, is decelerating. I mean, rates at Fed just got rates, but they're still too high for where the underlying economic activity is. So from the macro standpoint, we see other places outside of the world where, and this is important, that the probability of upside surprise is higher than here. Because in investing, the way you make money, the money is made at the intersection of expectations and reality. You can get something that looks bad, but if the expectations are even for worse and they come in just fine, you're going to make money more often than not. So when we look today at the macro world, what's priced into the US market from the macro standpoint It's a soft landing, and that thing's going to be fine. But let's not forget that the Fed is still very tight. We're going into one of the most contentious elections in the history of the United States. And each candidate has their own policies for foreign trade that could bring some surprises. There's always a risk that the Fed makes a mistake. So when we look at the macro and then we combine with the valuation, US again is one of the most, it is the most expensive market in the world. Even when you equal weight to account for the big weight of the technology, it's still more expensive than other parts of the world. So that's the one. The valuation, the value opportunity for us is outside of US. From the macro standpoint, we're most likely to see positive surprise. It's also outside of the US. So you're going outside when people don't expect good things to happen, and you getting compensated to take that risk. Now, if you look at the Mag 7, it's I think mid-teens percentage of our index, which is the MSCI All Country World Index. All the Mag 7s are domiciled in US. So if you adjust that US underweight, because all the tech names are in US, our underweight is not as severe, but still underweight the US.
So it's just to drill down on that, it's more a statement on the US macro situation than it is on the tech companies in particular.
I'm glad you followed up with that, because I just realized I didn't answer the particular US tech question. Look, the US tech names are expensive. I know that they are very profitable. They're the most profitable they've been. They've done incredible. A lot of the returns that you've seen over the last few years is justified because stock prices follow earnings. But we're value investors. So when you think about the value of the business, I'll tell you it's comprised of two components. There's one component which is what is the business making today? Okay, so whatever their widgets they're making today, whatever their earnings is today, this is what you can see, what you can count. So that's one portion of the value of a business or price. The other part is what is the value of the future growth opportunity? When you're dealing with companies like technology companies that are in a growth space, they tend to have a much greater part of the value to come from the future, expected to come in the future. It still has to be earned. Versus if you look at a bank, they trade at 1x price to book. The book is right there. You can see it today. If you liquidate it, that's what you get. So to us, when we look at the multiples of the tech names today, especially some of the bigger ones, and then you step back and you ask yourself, let me go back and look for last 100 plus years. How many companies at this size, at this point in the cycle, at this valuations, have done really well, have gotten even bigger, even more expensive, or have grown in valuation? They're not that many. So we're big into probabilistic kind of thinking about the world. Everything is a distribution. It is possible that something like Nvidia, someone like Nvidia can continue to go up. But if you look in the history, the chances of that happening are very slim. And if it does, it's considered a tail event. Then you ask yourself, are you willing to pay to take that risk? Are you willing to take the other side that this is the good investment? It may be, but then you have to ask yourself, how much are you willing to invest there? Well, look, we're value investing. We're allergic to high prices, to high valuations. So when we see something that's trading at 40, 55, 50 or plus times earning, all that if they don't know, it's going to take me 50 years to get back. So much happened in the last 5 years. I have no idea what's going to happen in the next 50 years, but I know a lot of businesses are not going to be around. And at the end of the day, businesses are run by people, and businesses do well and go bust because people. At some point, somebody is going to step in and is going to do something. Look at what we have today with Intel, with Boeing, with Xerox is gone. So you look at the history and you ask yourself, are you being compensated to take that risk? Now, look, they've been great investments. And if you interviewed me last year, I would have said the same thing, and I've been wrong. But you also have to understand, in investing, you have to know what you know and what you don't know, what you're good at and what you're not. If I start going and playing the game that the growth investors play, I'm going to lose. But if I stick with what we know well, what we do well, more over time, we'll do fine.
I think that's just such an important point to just sit on for a second, and something that I think it's taken a while for me to learn doing this podcast and learning about investing is there are so many ways to make money in the market and so many different investment styles and trading strategies that all have merit. But the biggest way to lose money is to try and do them all. And it's like, you got to figure out what you're good at and then be committed to it long term, and then build your skills in like a particular style of investing. Because too many people go wrong jumping from expert to expert, interview to interview, book to book, and try and do a bit of everything.
Yeah.
Oh, you said it great. That's exactly what it is. Yeah. You got to know what you're good at and then stick with that.
Now, Sorin, another key takeaway from the portfolio is just how globally diversified you are. Many of your top holdings are European and Chinese companies, and compared to the index, as we've spoken about, you are certainly underweight US. So how much of that is driven by the macro country level factors at those, I guess, particular regions versus company specific factors?
Ultimately, the size of our exposure is a function of the opportunity set, the conviction level, both at the macro, but also, can we find cheap stocks that we think are so cheap and it would cover all the risks that we're being compensated to invest in them? So when you see our exposure today, the biggest overweight is Europe, because Europe, remember a few years back when the war in Ukraine started, Europe was supposed to freeze. Europe has been an underdog for the last few years. Their growth hasn't been anything amazing to write home about. But somehow, under the surface, some of those companies are chugging. And even then, doesn't mean, like, it's an important nuance. Just because we might like Europe doesn't mean let's go and fill up the Europe bucket. What you own in a particular country is so important. In fact, it's more important what you own in a country than the exposure you have there, at least in how we think about it. Because I know in this industry, it's so easy. We get compared to the benchmark, and consultants look at us, oh, you're overweight, you might like the country. Like, no, I'm there because I like this one company. I don't care what else is in that country because I like this particular company. So yes, so to answer your question, the sizing that we have today is because some country areas like Europe, one, it's a lot of countries, it's a lot more diverse. The expectations are low, and we can find a lot of cheap companies. And now the ECB started cutting rates. You cut rates, you not only, it's stimulative to businesses, they can invest, consumers can spend more. That usually signals the beginning of the next cycle, right? So we're trying to position ourselves for that. ECB already starting cutting rates. UK is cutting rates. So we like that backdrop. China is one that's interesting. We've been there for a couple of years, and let's say, in the words of value investors, we are just early, not wrong. But China is one of this phenomena where we only have two names. It's the Baidu and Alibaba, where the way we think about China is, you get on a cab today, and ask anybody what's wrong with China, and they will list you a laundry list of what's wrong with China. That when you get those kind of answers, that tells me, okay, everybody knows what's wrong with China, but can we list of what can go right? And I'll never forget at the end of 22, when everybody was looking at us like, China's in lockdown, they will never open up. And then literally, I didn't expect that. A month later, they opened up. Everything kind of went back really, really, really fast. So again, things are never as bad as the market thinks or prices in, and they're never as good as the market thinks. Over time, whatever is up a lot is going to go down, and whatever's down a lot, it may go away, or more often than not can go up. So we see China as a place that is hated, it's out of favor, it's really cheap. I mean, we own the Google and Amazon of China that trade at 5-6 times PE versus the US counterparts. And I'm sorry, but everybody's telling me the worst risk, right? The geopolitical. Well, if that happens, NVIDIA can make chips, Apple can make a phone, but they're trading at these multiples, where these ones are trading at, the Chinese stocks are trading at X multiples. So when we see that, we tell ourselves, okay, this is a risk that we're willing to take. There's a chance that we could be wrong, and that's where risk management comes in. We'll calibrate it in a portfolio that it doesn't hurt us much, but we can still make good money. So it gives you an idea of how we think about the world. We tend to be a bit contrarian. We tend to go in when it's uncomfortable. There's a big behavioral aspect to value investing. If it's too comfortable, then everybody knows what's going to happen. The biggest mispricing is when it's uncertain, and we'll do that.
Well, Sorin, speaking of uncertain and uncomfortable, I want to turn to the airline industry, because that is an industry that has certainly been uncomfortable and uncertain with Boeing's troubles, their safety concerns, and the like. And now recently we've seen some struggles with Airbus as well. You own a number of aircraft-related stocks in your portfolios. I think the world's largest lessor of aircrafts and 3 airlines. So
Yes.
Can you talk to us about your view on the airline industry at the moment and how much those investments are driven by what's going on with the big manufacturers?
Sure. I think you set it up perfectly for me. It is a shortage of planes.
That's our job.
That is at the core of our thesis. We have a positive view on the airline industry, particularly because of what's going on at Boeing. Boeing is, and I don't know if I get this statistics right, but I think they were supposed to deliver 2,700 planes since 2019 that they haven't been manufactured. And based on what's been happening over the last week or so, I don't think they're making a lot of planes now. So you're dealing with an industry that the travel industry, the airline travel industry, that has pretty much returned to pre-COVID in most parts of the world, to pre-COVID levels. Everybody wants to travel. I just went on vacation to Europe with my family, but there's not a lot of planes to fill. So when you have a shortage of planes, it's microeconomics 101, supply demand, prices go up. Now this may not be great for customers because I'm sure you've seen prices have gone up and they stayed elevated, so it's not cheap to fly anymore. But the reality is some people still want to travel. Some people have the money and will spend the money to travel. So you're dealing with a very tight supply that is not going to get corrected overnight. It's going to take a long time to bring that supply. And on the other hand, you have demand that's back to pre-COVID levels. So then the last variable you have left is what else can hurt airlines? Probably fuel prices, but that's been coming in. So we own 3 airlines. In fact, for the Australian fund that we have, we can own Qantas, but Qantas is one of them that we're invested. We own Delta, one of the best airlines in the world. Copa, it's a Panamanian company. It's amazing competitive positioning. It's right in the middle between North America and South America. They only fly one type of plane. Their pilots only train on one type of plane. The altitude where they're positioned saves them money on fuel. It's incredible. And then we have Qantas, which is a little bit of a turnaround story, but also great position in the Australian market. We think that and these stocks trade at mid-single digits PEs. They're so cheap. They're profitable, and they still have this shortage of aircraft as a tailwind.
Yeah, it's fascinating. We were doing some content with an airline recently, and they were saying how the dynamic has changed since COVID, because a lot of these carriers have also retired the big A380s. And so a huge amount of capacity has come out, and now they're kind of sitting there thinking they were going to get all these orders from Boeing and thinking maybe we need to get our A380s out of the desert and get them flying again because there's just not enough capacity. So it was pretty interesting, the dynamics that are playing out. Well, Sorin, to close out today, the whole conversation has been around multiple ways to win and specifically centered around valuation and your adaptive approach. So, to summarize and to close, are you able just to talk through the valuation of the portfolio and perhaps where it sits relative to index and the value index?
So I know it's not the news that the value hasn't been doing well year to date, and we've definitely felt that. I've been at Brandywine for 11 years, basically for the duration of the strategy. Sometimes you look at your portfolio like in history, and parts when it looks really cheap. And today is one of those times. Our portfolio trades at around 11 times PE multiple. I think that's compared to, let me check real quick. I think it's compared to 15 times for the value index. The MSCI All Country World Index Value Index is 15.7, and the broad market, the MSCI ACWI, at 21 times. It's only been 7 other times in the history of the strategy that the portfolio is traded this cheap. We own some really cheap businesses, but not cheap, undervalued. We have great businesses like Qantas, banks in Europe like BNP Paribas, Santander. We have Delta, we have Citi. We have so many stocks that are cheap, undervalued versus the market. And in the past, whenever that happened, again, past performance, disclaimer here, is never guarantee of future performance. But if this were a stock, this is when you said, wow, versus history, it looked really cheap. And in the past, the subsequent quarters and years tend to be very good in terms of performance. I don't know when that's going to happen. If it's going to happen again, can't make promises. But today, we love what we own. We have some really high quality businesses. We're going through a bit of a turmoil, to use airline analogy. We have a bit of turbulence in the global economy. But if you look out a year out from now, and if we all go like have the soft landing in US, nothing gets destroyed in the global economy, you could be looking at a world where interest rates are much lower, people are start spending again, we're growing again, and a lot of the names that we own are positioned very well to benefit from that. And you're not paying a lot to play that for that upside.
Nice. Well, Sorin, it's been an absolute pleasure speaking to you today. Thank you for taking the time all the way from Philadelphia. We certainly took a lot out of that interview, as I'm sure many of our listeners will have as well. So thank you so much. We really appreciate your time.
Thank you. Thank you, guys.
Thanks, Sorin.
Thanks for having me.
And if you would like to find out more information about Brandywine Global, company by Franklin Templeton, you can head to brandywineglobal.com. We'll include a link in the show notes.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.